This week, the Federal Reserve is expected to cut rates for the first time in 2025. What's going on, guys? It's Ricky with TechBud Solutions. We have a few things to talk about before the Fed or FOMC rate decision on Wednesday. Let's go ahead and jump right into it. All I hope is that you learned something new, and if you do, please consider dropping a thumbs up and subscribing if you feel like we earned it. So where does the market currently sit before the FOMC rate decision? So the market currently sits at all-time highs. QQQ is at 591, and then we have SPY at 660. So if we look at the day chart, S&P 500 market at all-time highs, NASDAQ market at all-time highs. The reason I love this is that we're going to see what is going to happen after this rate decision actually takes place. So for those that do not know what to expect, maybe this is the first time that you're experiencing this, you're newer to the market, I want to break this all down for you. So this week is the FOMC rate decision. When is it? Super simple. So if you head on over to investing.com, you guys can see that they have an economic calendar. I would encourage you to find an economic calendar that you like. When you click on this week, it shows you the list of different economic reports that are set to be released. The most important one, in my opinion, this week is on Wednesday, September 17th. And that is, if I'm not mistaken, at 2 p.m. Eastern time, which is 1400, the FOMC rate decision. So at 1400, 2 p.m. Eastern time, the market will react to this interest rate decision. According also to investing.com, according to the most recent Fed rate monitor tool, there is a 99.9% probability that the Federal Reserve is going to cut by 25 basis points. This is what it means. And this is where we're currently at. There is a 0.1% probability that the Federal Reserve is going to pause. Now, let's talk about the details first. How does this play out? So for those that do not know, yes, I do plan to live stream the FOMC rate decision, and I do plan to do that on Wednesday. All you need to do is subscribe to my channel and drop a thumbs up, and I will take care of the rest. I will most likely go live about 10 to 20 minutes before the rate decision so we can prep for it, just for all those that are a little bit newer. So what do you need to know? We know the expectation, right? A 25 basis point rate cut, nearly 100% probability according to this tool on September 17th. Again, after the rate decision, the thing that I want you to understand is that 30 minutes after, if you look at the actual economic report, 30 minutes after the rate decision, there's an FOMC press conference. You can see from 1400 to 1430. This is really important because often the market reacts to the rate decision based off of what was expected. And in this case, it's a 25 basis point rate cut from 4.5 to 4.25, right? Based off of what is expected and what is reported, the market will react. If you want markets to go up, you most likely want it to come in at a 25 basis point rate cut or more. 50 basis point rate cut, markets could skyrocket. But for some reason, I'm not saying that it's possible, you just never know. For some reason, if the Federal Reserve chooses to pause and they don't cut rates, get ready for markets to drop. Why? Markets have been factoring in that the Federal Reserve is going to be cutting rates. They've been begging. Trump has been demanding. He's been threatening Jerome Powell, who's the head of the Federal Reserve, to cut rates because the economy is slowing down. The labor market has been showing signs of it slowing down. You might be like, Ricky, that doesn't make sense. How is the market slowing down? How's the labor market so weak, but markets sit at all-time highs? Correct. And inflation has been creeping up. So you might be asking, well, why hasn't the Federal Reserve cut rates more aggressively prior? They were expected to in the start of 2025. But then Trump came in and announced tariffs. This is what I want you to understand. I don't need you to agree with me. I'm just expressing to you what has been expressed by the Fed. People like to point the finger and said, no, the Fed is against Trump. The Fed has been precautionary. They were expected to cut rates, but Trump announced tariffs and really high tariffs. Tariffs are inflationary. They have a history of causing inflation to go up. So the Fed began to be cautious. They wanted to wait and give the market the time that it needed to see if data supported a rate cut, because how terrible would it be? that if all these tariffs got announced, inflation was relatively pretty low. If they began cutting rates, it would just expedite inflation to go back up to the 9.1% that we experienced at the peak of 2022, if I'm not mistaken. Remember when inflation was incredibly high after the post-pandemic rally? This is what this market kind of reminds me of. There's a discrepancy, right? What the economy is currently feeling is not what the stock market is currently showing. There's weakness in the labor market. There's weakness in our economy, but the stock market sits at all-time highs and inflation is beginning to creep up. And that's kind of the pickle that the Federal Reserve is in right now. They need to decide, do we want to continue to cut rates aggressively, or do we want to begin to cut rates aggressively at risk of causing inflation to go higher quicker? Of course, it would help out the labor market. Of course, it could help out our economy, but then inflation would begin to rise. And remember, that's one of the Federal Reserve's mandate. I just wanted you to understand why. They focus on inflation and they focus on a strong labor market, and they can raise or cut rates accordingly. So that is what is expected with this FOMC rate decision. And I wanted to ask investing.com a very simple question. So if we go to Warren AI, I asked, based off of history, how does the market normally react after an FOMC rate cut? And then it said, historically, the US has posted an average gain of 10.4% in the 12 months after a Fed rate cut. I felt like that was worth sharing. Remember, patterns tend to repeat themselves. They don't always have to. That is based off of the 8 out of the 10 rate cutting cycles since 1982, delivering positive returns. So again, nearly an 80% probability that yes, most likely markets react in a bullish way 12 months after. I think that's important to note. Not that they have to happen, but that they tend to. Though results have ranged from a negative 23.9% drop to a blistering 32.1% rally, the crucial variable, whether cuts extend an economic expansion if it's too late. So the part that I really liked, the way that it broke this down, is that if you were to type this into ChatGPT, in my opinion, it doesn't give you information that is guided for investors or for traders. And in this form of Warren AI, which is Investing Pro's version of ChatGPT, I feel it's very suitable and made around investors and traders. And then when you also ask the question, bull markets with an asterisk, right? It expands on the idea that US stocks remain in bull markets as long as nothing breaks in the economy. Something super important to note. Remember, anytime that there's been strong corrections, there's always been something that breaks. When the Fed cuts rates to support ongoing growth, equities often keep rising. You might be asking why? Why, when the Federal Reserve cuts rates, do markets rise? Remember, when you borrow money, it is based off of interest rates. And if interest rates are cheaper, let me just explain it to you in a very human way. If interest rates are cheaper, that means that the rate that you pay is less. So instead of paying $8 for every $100 you borrow, now maybe you can only pay $4 or $2. It might encourage you to spend more money, to borrow more money, because interest rates are simply cheaper. That's the same way for most Americans, and that's the same way for businesses. When rates are cheaper, markets tend to boost because it is cheaper to borrow money, therefore less of an expense. But when is it not, right? Biggest flops, when cuts failed to stop recessions, the early 2000s, the dot-com bubble, and 2008, the housing market crash, right? The other thing that I wanted to highlight is when we saw that pivot from the Federal Reserve when they went from cutting rates to raising rates, right? That was in 2021 to 2022. That was a post-pandemic rally. That's the part that I'm going to be very excited to follow up with, is that we are truly watching history kind of create itself. We've experienced the post-pandemic rally for those that partook in that. For those that were around during the housing market crash, cool, right? We experienced the trade war flash crash, right? That was early this year. And now we're going to be experiencing this possibly for you guys, for some of you, for the first time. So now you get to actually see what it might be like to see the market either rally after a rate cut, or if something breaks and it does not boost our economy because we have such a weak labor market and economy, maybe we can see a retracement. But based off of probability, 8 out of 10 times you tend to see a rally. And we'll see. We'll see what actually presents itself this week. And the reason I'm so excited about this is that, remember, markets are at all-time highs. So right now, as markets continue to push because they're expecting this rate cut, and technically speaking, markets are a leading indicator. They like to factor things in advance. So therefore, everything that might not actually be performing well is doing well because market environment supports it. Bad companies, although they might be doing poorly, can still thrive during bullish markets. But this is the thing that I want to highlight. If the company that you're invested in, that you're trading aggressively, please be careful. At these elevated levels, if they're incredibly bullish, but fundamentally they're not well-run companies, if we do see a break in this market and markets begin to retrace, it is those companies that fundamentally never belonged there that will experience the hardest retracement. Take 2021 to 2022 as an example, where you saw companies like Open go from highs of $39 per share down to, at that point, 79 cents per share. And now recently, we've gone from 51 cents per share to highs of $10 per share. Or, again, not just Open. We can talk about CoreWeave. We can talk about TEM. We can talk about any of these incredibly bullish companies right now that fundamentally have not been doing well. So if market sentiment begins to shift, not saying that it will, but if it does, please be cautious with your exposure at these elevated levels. That's all I want to encourage you to do, to look out for yourself. And remember, we've said it before, this is why it can be so useful to be able to really perform a technical analysis on the different companies that you are investing in, right? So for TEM, I can plug it in right here to Investing Pro, and right off the bat, I can have access to, hey, this is a company that loses $200 million every single year in net income. It has a negative 74.6 PE ratio, meaning from where the company is currently valued at to what the company actually makes as a business, you're paying a huge premium, right? And for some businesses, it even provides you a full map of how this company actually makes its revenue. So if you are someone that is not only trying to be a technical trader or a technical investor, but you also want to understand the company fundamentally, at least for me and my experience, it is so much easier to digest all of this information in a more visually appealing way. And that's all thanks to Investing Pro. It is not free. I want to be straight up with you guys. Investing Pro, is a subscription, but in my opinion, it comes down to how informed do you want to be? And if you see value in this and being more self-sufficient, to not depend on other people to tell you what to invest in or to tell you what to trade, but you can do all the research yourself, like, again, how beautiful is this? I can look at their full financial models for the past year and see how much Tesla has made, their revenue, and their cost breakdown of their net profit of $5.9 billion. And when I look at the final numbers, $5.9 billion, that they're not just numbers, but I understand the full flow of the way that Tesla makes money. Again, being informed. As of right now, from the 15th of September to the 18th of September, so you have 3 days, they have a 50% flash sale. On top of that, you will get an additional 15% off if you use my promo code Ricky. I'm going to link it down below. The first link in the description down below will get you not only the 50% off for their flash sale right now, but an additional 15% for using promo code Ricky at checkout if you want access to Investing Pro. Of course, again, you do not need it. But if you want to save big and you want to dive deeper into the companies that you're investing and trading, then why look any further? First link down below, you can feel free to check it out. So again, I hope that this video gave you a better understanding on how to prepare for your first FOMC rate decision. We will be live streaming it for free on this YouTube channel. And all you literally need to do is drop a thumbs up and subscribe. Don't forget to tune on into our live trading sessions. I trade live every single morning right at market open. And that's that second link in the description down below. Like always, let's make sure that we end the year on a green note. Take care, team.